Good morning, participants. I hope you are all able to hear me and see me. The regular faculty, Mr. REV GNIIT is not available at this moment, so I am going to take your class till next Monday. After that, the regular faculty will come back. So till such time, till next Monday, I will be taking your classes. My name is Anup Ray. I hope nobody has problem of audio or video transmission. You are all able to hear me. Any audio problem or video problem, please point out before I start the session today. So today we will be talking about inventories. So we will discuss definition and scope or application of inventories in different scenarios. We will apply the concepts to relevant business transaction and how to determine the appropriate value of the inventory, the treatment and the accounting requirements under IFRS, and particularly the difference between IFRS and US GAAP so far as inventory accounting is concerned. As you all know, inventory is the major component of both the cost of goods sold and also current asset. Cost of goods sold is required for the determination of profit and loss to arrive at the gross profit. Sales minus cost of goods sold is the gross profit, both for manufacturing as well as trading businesses. So for cost of goods sold determination, we need to have opening inventory, closing inventory as well as figures relating to purchases. Also, inventory appears as a balance sheet item, so for both for profit and loss accounting and balance sheet, determination of inventory becomes, value of the inventory becomes very important. So we will talk about IFRS pronouncement, which is in IS2. International Accounting Standard 2 deals with the inventory. So the main issue with respect to accounting for inventory under IS2, basically the main issue is the amount of cost to be recognized as an asset. So the main issue that we will be discussing is amount of cost to be recognized as an asset for the inventory determination. In addition, IS2 also provides guidance on the determination of cost and subsequent recognition of expense, which includes writing down the inventory to its realizable value. So these are the things we are going to cover in today's session. So first let us try to understand what are inventories. That is, definition of inventories. Let's try to understand that. So the definition of inventories, basically inventories are held for sale in the ordinary course of a business, like a merchandise purchased by a retailer. A retailer who is carrying out a retail trade, he purchases certain merchandise and at any point of time he will be holding some merchandise in his shop. That is what is inventory. Similarly, for a manufacturer, assets which are held in the process of production for resale, like finished goods, work in progress and raw materials. For a manufacturing industry or business, inventory consists of raw materials, stock in process and finished goods. Inventory also includes materials or supplies to be consumed in the production process or in the rendering of services, like tools used in the production line. So what we call basically consumables and various kind of supplies which are required in the production process or in the rendering of service, that is also inventory. So inventory is a broad definition for retail trade. For retail trade, it is basically the merchandise which are held in the ordinary course of business for selling, or in manufacturing business it is raw materials, stock in process, finished goods. It also can be consumables which are used in the production process or for rendering various kinds of services. So these are actually inventories. These assets are called inventories. In IFRS, International Financial Reporting Standards, inventories are covered under IS2, International Accounting Standard 2. And US GAAP, it is covered under ASC 330. So key differences between IS2 and ASC 330 will be discussing towards the end of the session. IS2 applies to all inventories. First, you have to remember IS2 applies to all inventories. Some do not come under IS2. So which are the type of inventories which do not come under IS2 are agricultural produce, which are referred to as biological asset. They are not covered under IS2, they are covered under a separate accounting standard called IS 41, which will not be discussing during this course, which will not be covered through this course. Mineral and mineral products, that is also not covered under IS2. Financial instruments as inventory held by the broker trader, these are also not covered under IS2. For there is separate standard is available. That is for financial instrument, there is separate standard available. The principle of measurement of inventory under IS2 is layer of cost or net realizable value. So they do not apply to those three kinds of inventories we talked about, like biological, minerals or financial instrument. They do not apply to those kind of inventory, so that's why they are not covered under IS2. So the principle of measurement of inventory under IS2 is basically layer of the cost or net realizable value. So basically at any point of time, the cost of the inventory will be determined either by taking the cost of purchase or the net realizable value of the inventory, if it is so. So whichever is there is taken as the value of the inventory. This principle doesn't apply to those three inventories we talked about: biological inventories, minerals or financial instruments. Yes, any question from Rituparna? We are doing inventories, lesson 2, session 7. It's lesson 2, session 7, inventories. Your faculty informed me that he has completed up to lesson 2, session 6, that is trial balance, etc. So next comes inventories. So that is what we are discussing. Is that clear, Rituparna? So comes the important question, measurement. So when we talk about cost, Lower of the cost or net realizable value, that is the principle for determination of the value of inventory under IS2. So what do you mean by cost? Cost will include all costs involved in bringing the inventories to their present location and condition. All costs which are incurred in bringing the inventories to their present location and condition. So the components of cost accordingly will be, there will be main three components of cost. One is the purchase cost, the amount paid to purchase that inventory. Next is cost of conversion. If the inventory is converted into some other form, whatever is purchased may be converted into some other form, like a raw material purchased by a manufacturer may be converted into finished goods. So through the process of production, so certain costs are incurred during the conversion of the raw material to the finished goods. That is cost of conversion. That's why cost includes all costs involved in bringing the inventories to their present location and condition. To bring the inventory to their present condition, that means from raw material the inventory has been converted to finished goods. The cost involved in the conversion process is incurred for bringing the raw material from to the finished goods state. So three components of cost. First is the purchase cost, second is the cost of conversion, and third is other cost. So the components of cost could be purchase cost, purchase price, all costs directly attributable to the acquisition such as non-refundable taxes, import duties for imported inventory. Import duties have to be paid at the border when the inventory is imported into India. Customs has to be paid the import duties, if any, applicable on that type of goods. Non-refundable taxes could be sales tax, VAT, etc. Then transportation and handling cost. To bring the inventory to the present location. So transportation cost may be involved in bringing the inventory to the present location. The transportation and handling cost also will be included. If any volume discounts and rebates were given by the seller of the inventory or seller of the goods from whom we purchased the inventory, if any volume discount or rebate was given, so that the cost will be reduced by that volume discount or rebates. So three components of cost we are discussing about. One is the purchase cost, second is the cost of conversion, and other cost. We'll see an example. After a few slides, we'll see an example of the various kind of costs which are involved in, various components of costs which are involved in determining the inventory, cost of the inventory. So the conversion cost, it can include direct material cost, direct labor cost, other direct cost, variable and fixed production overhead cost. So variable production overhead basically is allocated to inventory based on the actual usage of that overhead, actual usage. Fixed production overhead is allocated to production based on the normal operating capacity. So variable production overheads are normally allocated to inventory based on the actual usage of that item or cost, item of cost, whereas fixed production overhead is allocated to production based on the normal operating capacity. When abnormally high production takes place, of course that will not hold good, but when the operation is within normal limits, that means then the allocation of the fixed production overheads is made to the inventory based on normal operating capacity. How much of the operating capacity has been used based on that. Other inventory variable costs are basically costs that are incurred in bringing the inventories to their present location and condition, like amortization of capitalized development costs related to inventory. The borrowing costs are included. If the entity has borrowed money, then the cost of borrowing money for purchase of inventory or for conversion costs, they can be included if they are for a qualifying inventory item. So it must be for a qualifying inventory item, the borrowing cost can be included. If measured at the face value of product produced in large volume on a repetitive basis, borrowing costs may be capitalized. Otherwise, it can be included. So we'll see some examples to understand in specific situations how this various component of cost are added up to arrive at the cost of the inventory. Costs which are not included in determining the inventory cost of the inventory are basically cost of abnormal wastage of material. If there is abnormal wastage of material or labor or production cost. Similarly, storage or warehousing cost unless necessary for the next stage of production. If the storage or warehousing cost is necessary for the next stage of production, it will be included, but if it is not necessary for going over to the next stage of production, then the storage or warehousing cost will not be included in the cost of inventory. Administrative overheads, which are not associated with production, will be excluded. Administrative overheads, if are directly related to the production process, then they can be allocated to the inventory. But otherwise, administrative overheads will not be, which are not associated with the production process, that will be excluded. Like selling cost, like commission paid to the sales agent, etc. So any selling cost will not be included in the cost of the inventory, and financing charges above the purchase price for normal credit terms, that will not be included. This is basically what is included and what is excluded we have discussed for the purpose of determining the inventory cost. Service providers, in businesses which are engaged in providing services, inventories of service providers are measured at the cost of their production. That is the cost of the inventories of service providers. Like labor cost, it will include labor cost plus other cost of personnel directly used in providing service plus attributable overheads. So if a business is engaged in development of software, they are basically a service provider. So a software which is still in the process of development, how the cost of that software or how the cost of that inventory measured? Basically labor cost plus other cost of personnel directly used in providing service plus attributable overheads will be taken into account for determining the cost of the inventory. But it will exclude profit margins and non-attributable overheads that are generally used in prices quoted by service providers to the customers. When the service provider is providing service to the customers, when they are quoting the cost of the service, they are also including profit margins and other non-attributable overheads in their pricing. So those profit margins and non-attributable overheads will be excluded for determining the inventory cost. So we look at an example here to understand which costs can be included or which can be excluded in a specific scenario. So let's look at this example. A company does trading by importing a commodity from different countries. So the business is engaged in trading business. They import commodities from different countries but export the same to a specific country. That is a business. Last slide, okay. Just a minute. Somebody wants the last slide, so I will wait for a few minutes for him to finish, and then we'll go to the example. So Faisal, when you are finished, let me know. Okay, thank you, Faisal. So company's business is importing commodity from particular commodity from different countries and exporting the same to a specific country. So it's in the export-import business. The following expenses are incurred during the year. There is a list of expenses which have been incurred during the year. Which one of the following costs are permitted under IS2 to be included in the company's cost of inventory? So let's look at the various items which I mentioned here, various items of expenses, and which can be included for determining the cost of inventory and which should be excluded. Let's try to understand that. So first one is the cost of purchase. Cost of purchase of the commodities which are being imported. These are based on the vendor's invoices. So will it be included in the cost of inventory? Yes or no? Waiting for your response, so please come up with your response. The first item, will it be cost of purchase, will it be included? Okay, I got the answer from yes. Fine, it will be included. Trade discounts on purchases. So when the company imports, the vendors also provide sometimes trade discounts. So trade discounts on purchases, will it be included or not included? In fact, for determining the cost of inventory, it will be reduced. It has to be reduced. So it has to be taken into account. It's basically trade discount on purchases. Supposing you are buying a large volume. When you are buying a large volume beyond a certain number, you may be entitled to a discount which is given by the seller. So that reduces your cost of purchase. So this is to be reduced from the cost of purchase. Any trade discounts, as you remember, I will go back to the particular slide. Reduced by volume discounts and rebates. Purchase cost includes the purchase price. It includes all costs directly attributable to the acquisition, such as non-refundable taxes, import duties, transportation and handling, and it will be reduced by the volume discounts and rebates. So trade discount is basically rebate or a discount provided by the seller of those goods. So your cost of purchase has to be reduced by the trade discount. So it has to be taken into account, so it will be included. Import duties. Alright. Will it be included in determination of purchase cost or not? The goods are being imported from other countries, so import duties have to be paid to the customer. Yes, it will be included. Thank you. That answers correct answers from three of you. Other handling costs relating to imports, whether it will be included or not. Oh, sorry. Freight and insurance on purchases. Sorry. Freight and insurance on purchases. When you are importing goods from other countries, so you have to pay the freight. That means if you are importing by ship or by airlines, you have to pay the transportation charges. So freight and insurance on purchases, it will be included, correct? Okay. Other handling costs relating to imports, will it be included? Again, yes. Very good. Now comes salaries of the accounting department, salary paid to the accounting department. Will it be included? Okay, again I got the answer. Yes. No, it is no. The answer is no. Administrative overhead is not related to this. It's administrative overhead, not related to the business of importing or exporting. Brokerage commission payable to indenting agents for arranging imports, will it be included? Brokerage commission payable to indenting agents for arranging imports is a part of the cost acquisition. So you pay to the broker, it will be included, yes, it will be included, because you pay to broker who arranges the imports for you. So this is a cost, this is a part of the cost of purchase. Without the help of the broker, you may not be able to locate the vendors or arrange for the import of those goods. So you are paying commission to the brokerage commission to indenting agents who are arranging the imports. So it will be included as a part of the acquisition cost. The correct answer is brokerage commission will be included. It's not no. Okay, it's yes. Sales commission payable to sales agents. What about that? Sales commission payable to sales agents. It will not be included. It is no. Because it is very clear. Again, I go back to that slide, relative slide, just to remind you. Excluded. What are excluded? Selling cost. Cost not included. Please look at this slide. The last one I can. Selling cost is not included. So when you pay sales commission to the selling agents, that is not a part of your inventory cost. Is that clear? After sale warranty cost. After sale warranty. So sometimes after sale warranty is given. So whether that cost will be included. Again, it is relating to your selling cost. So it is not. Again, the answer is no. So cost of purchase, trade discount on purchase, import duties, freight and insurance on purchase, other handling costs relating to imports, and brokerage commission payable to indenting agents for arranging imports. These are the expenses which can be considered for arriving at the inventory cost. The other items, salary of the accounting department, sales commission payable to sales agent, and after sales warranty cost, this will be excluded, not considered for arriving at the cost of the inventory. Is that clear? Now we'll come to valuation. Initial measurement will be always at cost. We have talked about the cost. We know what has to be included, what has to be excluded. So initial measurement of inventory is always done at cost. So for the first time when you are passing accounting entry for any item of inventory which has been purchased, it will be done at the cost. So initial measurement will be always at cost. But what happens to subsequent measurement? Supposing at the end of the year, some inventory is left in the business. Some inventory is still left in the business, unsold inventory. At the end of the year, what value you put to the unsold inventory? The subsequent measurement at lower of the cost or net realizable value. So you have to consider the cost of that inventory, that is the initial measurement as per the initial measurement. You have to also consider the net realizable value of the inventory. If the inventory is sold, how much net realization will be obtained from the inventory, sale of the inventory. So basically the lower of the two. So you have to compare the cost of that inventory, unsold inventory, with the net realizable value of that unsold inventory, and whichever is lower you have to take that as subsequent measurement of inventory. So inventories are usually written down. The value of the inventory can be written down on item by item basis. So each item of inventory can be looked at, and if the subsequent measurement can be done. And if subsequent measurement, that means the net realizable value is lower than the cost, we have to write down the inventory because the initial measurement was at cost. So writing down of the inventory will be required when at the end of the year the unsold inventory you find at the net reducible value of the unsold inventory is less than their cost. So, till that time, till the end of the year accounting period, the inventories were measured at the cost. But now, at the end of the year, when you are ending the accounting period, you have to take a look at the net reducible value of the inventory, compare it with the cost of the inventory as per the books. And if you find the net reducible value is lower than the cost of the inventory, that means you have to write down subsequent measurement will be the net reducible value of the inventory. Supposing certain items of unsold inventory is there. Let's say the cost of that inventory is 50,000. Now, when you also try to estimate the net reducible value of the inventory, you can only estimate it. That's an accounting estimate. So you can try to make an accounting estimate of the net reducible of the inventory. It comes to 40,000. Now the inventory is carried in the books at 50,000, but its net reducible value is 40,000. In the subsequent measurement of the inventory should be 40,000. That means in your balance sheet, the inventory should be shown at 40,000. That means you have to write down the inventory from the value recorded in the books, that is cost 50,000, to its net reducible value, which is the subsequent measurement of the inventory. Then only writing down will be needed. But if supposing the cost of the inventory is 50,000, but its net reducible value is 55,000, then no writing down is involved, because then the inventory will be, subsequent measurement will be lower of the two, so 50,000. So no writing down is involved. Writing down is only involved when the subsequent measurement of the inventory is less than the value at which the inventory is carried in the books. Then writing down is involved. The inventories are usually written down on an item by item basis. So each item of inventory can be looked at. The cost of the inventory as per the books is compared with the net reducible value of the inventory, the estimate for that. And if necessary, writing down can be done. And writing down can be done by item basis, or inventories can be grouped to similar items whenever appropriate. We'll see an example in the next slide regarding grouping of items of inventory of similar nature. That also we'll see. So writing down of inventory can be done item by item, or it can be done by grouping the similar items of inventory and then writing down for the group whenever it is appropriate. Now the calculation of energy, if you please understand, it's selling price, how the net reducible value is calculated or estimated. It is not it is basically an estimate. How it is estimated. So we look at the estimated selling price of the inventory. How much the inventory can be sold for in the market. So the business will have to answer this question or try to estimate what if they sell the inventory, how much they will be able to sell it for. And for selling, if they have to provide a discount, then the discount should be reduced from the estimated selling price. If the inventory is half finished, then you cannot sell it, so there can be some cost of completion involved before selling the inventory. So estimated cost of completion also has to be reduced from the estimated selling price. If selling costs are involved, like paying to the selling agents, etc., those also have to be reduced from the estimated selling price. So three things will be basically, an item of inventory can be, the estimated selling price of that item of inventory can be considered, and from there we have to reduce discounts if any required to be paid for selling that inventory, any cost of completion that will be required to be incurred before selling the inventory, and any selling cost that may have to be incurred for selling that inventory. So these three have to be reduced from the estimated selling price to arrive at the net realizable value, which is just an estimate. Remember, it's an accounting estimate, nothing more than that. So this concept, what is the concept involved when you are talking about subsequent measurement at lower of the cost or net realizable value? What accounting concept is involved? Can anyone answer? We have talked about accounting concepts, accounting principle. So which accounting concept is involved in this particular principle we are talking about? The subsequent measurement should be at lower of the cost or net realizable value. Which accounting concept is here? Under which accounting concept we are saying that the subsequent measurement should be at the lower of the cost or net realizable value? Which accounting concept is it? That's a very important concept. Accounting concept, what is that? So can you respond on that? Yes, I am waiting for your answers on this, or your responses. Which accounting concept? No, Dibba, that is not correct. Which account? We have talked about certain accounting concepts earlier. Okay, so which accounting concept is invoked here? When we talked about, say, when subsequent measurement should be done at lower of the cost or net realizable value, which accounting concept is we are talking about here? Okay, I was expecting some response, right response from your side. You have learned about so many accounting concepts and principles. Okay, Shubham has come near to it, yes. Okay, conservatism or prudence. So Shubham and Vishal both have come with the correct answer. So it is called conservatism concept. It is called you have to be conservative. Prudence or conservatism concept, that is the right answer. So thank you. Thanks to both of you, Shubham and Vishal. It's called conservatism concept. You have to be conservative. When you are looking at two numbers, we take the lower one. We are looking at two numbers. One is the cost, the other is the net realizable value. So we'll always take the lower one. That is the conservatism concept. So basically the idea is never overstate, never do anything that will possibly overstate your profit. Okay, so that is the basic meaning. Okay, now we go to an example regarding writing down of inventory item by item or as a group. Okay, so a company has the following 4 items of inventory on a reporting date. On the reporting date, that is the date they are preparing the profit and loss account, balance sheet, etc. The company finds that they have 4 items of inventory on the reporting date. Towels, bed sheets, trousers and suits. Now the cost of the towels is 1,000 and the net realizable value of the towels is 900. Bed sheets 2,100 cost. Net realizable value of the bed sheet is 2,500. Trousers cost is 3,500. Net realizable value is 3,700. Suits cost is 7,000 and net realizable value is 6,200. Now if we do it, we can do the valuation of the inventory as on the reporting date, either item by item basis or on a group basis. So if we do it item by item basis, now for the towels, the cost is 1,000, NRV is 900. How much will you take as the values? For subsequent measurement, what should be the value of the inventory? The lower of the two. So for towels, it will be 900. Because they have to take the lower of the two. So when you are doing it item by item, for towels the cost is 1,000 and NRV is 900. We have to always take the lower of the two following that conservatism concept. Lower of the cost or net realizable value. So for towels it will be 900. For bed sheets, when you looked at the second item, cost is 2,100 and NRV is 2,500. Again you have to take the lower of the two. So 2,100. So for bed sheet it will be 2,100. The value of the bed sheet inventory will be 2,100 when you apply that concept. For trousers, cost is 3,500 and NRV is 3,700. So again for trousers, we'll take the subsequent measurement at 3,500, which is the lower of the two. And for suits, cost is 7,000, NRV is 6,200. Again, lower of the two is 6,200. So we'll take the value of the suits inventory at 6,200. So basically we are taking towels at 900, bed sheets at 2,100, so 3,000, trousers at 3,500, so 6,500, and suits at 6,200. So basically 12,700 will be the total value of the inventory. Subsequent measurement of the inventory will be at 12,700. Is that clear? When you are doing it item by item. Although in the books it is 13,600, but in subsequent measurement, based on that principle, conservatism concept, will value the inventory at 12,700. So that the write down involved here, 13,600 is the inventory is carried in the books at 13,600. Now you have to reduce the value of the inventory or the value of this asset to 12,700. So there will be write down of 900 involved when you are doing it on item by item basis. But if you are valuing this, doing the valuation on a group basis, because these are similar kinds of items, considering them as similar kinds of items, you can also go for group basis. So if you do on group basis, total cost is 13,600, NRV is 13,300. So we take aware of that. So then the value of this inventory, subsequent measurement of the value of the inventory on the reporting date will be 13,300, whereas the cost is 13,600. So write down involved will be only 300. So it can be done on item by item basis, or similar items can be grouped together for the purpose of determining the value of inventory, and if any write down that is needed for that. Is that clear? This example I think is very specific, and it is so. Solution is on item by item basis. Valuation of the towel will be 900, bed sheets will be 2,100, trousers will be 3,500, and suits will be 6,200. Always for each item we are looking at the cost and NRV and taking the lower of the two. And total value of the inventory when you do item by item, it is 12,700. It will require a write down of 900 because the cost of the inventory was 13,600. On a group basis, it will be simply 13,300 because when you look at the entire group of this inventory, similar types of items, then we can take the layer of the NRV or the cost, NRV being lower, 13,300. That will be taken as a subsequent measurement of this group, and the write down involved will be only 300. Okay. So the valuation can differ on the two cases. For the same inventory, the valuation can, as you see, the subsequent measurement and the valuation of the inventory on the reporting date can differ. Okay. Now, what are the techniques for measurement of cost? There are two methods. Two costing methods can be used for convenience. It results approximate the actual cost. One is standard costing method. The other is retail method of costing. Standard costing method is cost determination by using standard levels of material, labor, efficiency, and cost reduction. Particularly in manufacturing industry, how do we arrive at the cost of the finished goods inventory? That means you have to consider the raw material purchase cost plus you have to take into account the conversion cost. So there are two methods of costing which are used. The standard costing methodology is used in the standard in cost accounting. So those who have any exposure to cost accountancy or cost accounting, they know the standard costing method. Basically here the cost determination is by using standard levels of material, labor, efficiency, and capacity utilization. Okay. That is the method followed. I will not go into details of the method because that is outside the scope of this. So basically this is one method, standard costing. The other is the retail method of costing. Retail cost determination is done by reducing the sales value by appropriate average percentage of gross margin. So if you know, from sale of this particular item I am getting a gross margin of let's say 15%. Then for determination of the cost, I mean, list of the unsold inventory at the as on the reporting date. For determination of the cost, you have to, from the sales value is 100 rupees and 15% is the average gross margin you get on that particular commodity or product. Then 85 rupees will be taken as the cost. That is called retail method of costing. The retail method of costing, basically cost determination is working backwards. Determination of cost is working backwards. You look at the retail sales value of the particular item or inventory, what is the sales value, and reduce it by the percentage of gross margin, average percentage of gross margin that is basically earned on that particular item. So that is called retail method of costing. So either the standard costing methodology can be used, particularly in manufacturing. Other industries, they normally go for what is called standard costing methodology, which is cost accounting. Retail method is used when there are inventories of large numbers of rapidly changing items with similar values. This is basically a very practical means for measurement of financial reporting purpose, like production of ceiling fans. Now there are so many types of ceiling fans are there. Large numbers of rapidly changing items with similar kind of margins, then this is a practical means of measurement for financial reporting, like in the production of ceiling fans, etc. They use this method. So we will be just talking about this these two techniques which are involved in measurement of cost. But we will not go into details of this. That is outside the scope of this course. Again, for the cost formula. Okay, before we go into cost formula, we can have a small break at this point of time. After that, we'll talk about the cost formula. Welcome back after the break. So, for determining cost, there are two methods. For specific identification of inventory and the cost of that inventory, we have first in, first out method and weighted average method. Please remember, there is a third method called lost in, first out. IFRS doesn't allow lost in, first out method to be used. So either first in, first out method or weighted average method, one of these two methods can be used for items of inventory for which you cannot identify the actual cost. Either the actual cost has to be identified using that retail method of lending or standard costing technique, or otherwise for where identified actual cost cannot be measured, then for other items of inventory we go by first in, first out or weighted average method. So the cost under the first in, first out method, the cost of the units most recently purchased are considered. Whereas in the weighted average method, the weighted average cost of the units in the beginning and purchased or manufactured during the year is taken into account. FIFO method basically is used. Examples could be cards on production line. When cards on the production line are there, their costs are measured using the FIFO method, first in, first out. Weighted average cost is used for like items used in production or sold with regard to when received. So any of these two methods, FIFO and weighted average method, can be applied to the stock taking method the company follows. There is periodic or perpetual system explained. We'll talk about two systems which can be followed, periodic and perpetual system, which can be followed by any of the companies. So let's look at those examples. There are two systems. Although IFRS doesn't prescribe any particular system, two systems are in vogue. Two systems are basically used. Any of these two systems are used by most of the entities. IS2 doesn't suggest which inventory system is to be maintained. This is as per the organizational process and systems. So this is not really a part of IS2, but this is important from knowledge perspective. Nowadays, most of the companies are basically maintaining computers inventory, hence perpetual system is basically, since most of the companies are maintaining inventory, computers inventory, so perpetual system is based on the perpetual system. So what are these two systems? Under perpetual inventory system, detailed records of each inventory purchased and sold are kept and maintained, and it will continuously show what is the value of the inventory in hand. So in a computer's environment where the inventory, as and when they are acquired or purchased, it will be immediately entered in the system, and whenever inventories are issued, that also is recorded in the system. So you have an up-to-date record of each inventory purchased and sold, and the system is continuously updates the numbers. So at any point of time, inventory in hand can be measured. The cost of the inventory in the hand can be found out, determined. So it keeps, basically under the perpetual system, it keeps a track of both quantities and cost. The cost of goods sold is determined and recorded each time a sales occurs. So under the perpetual inventory system, it's a very detailed recording is maintained. And nowadays, because companies, almost any major company are maintaining the inventory in their computers with the help of a computer system, so it is possible to go for the perpetual inventory system. That is what is followed by most companies today. In periodic inventory system, which is maybe followed by mostly smaller businesses having no computer system available to them. So they generally resort to what is called periodic inventory system. Here no attempt is made to keep detailed inventory records of goods on hand throughout the period. Only at the end of the period, accounting period, inventory is, whatever inventory is left is found out and its cost is determined at that point of time. So during the year, at any point of time, the cost of the inventory may not be available because there is no record keeping. So detailed inventory records of goods on hand throughout the period is not available. So it doesn't keep a record of both quantities and cost. The cost of goods sold can be determined only at the end of accounting period when a physical stock count is taken, and then attempts are made to determine the cost of that inventory. So which system to be followed is not prescribed under IS2. The business can follow depending on the process, their system, etc. The business can follow either the perpetual method or the periodic inventory system method. So we'll see examples of both these. Perpetual inventory system and periodic inventory system, we'll see examples of both these, detailed examples. Let's look at the third example here. The following table displays an inventory product for the year. On 1st of January, that is at the beginning of the accounting period is from January to December. On 1st of January, the day the accounting period started, the opening inventory was 100 units and the cost per unit was 8. On 7th of February, a purchase was made, 400 units of inventory were purchased, cost per unit was 10. On 3rd of January, sales of 300 units of inventory was made, selling price was 12. On 3rd of August, again 500 units are purchased, cost per unit was 12. On 2nd of October, 400 units are sold at 15 each. 5th of November, again a sale of 100 units took place at 16 for each unit. And 8th of December, again purchase of 200 units are made at 13 per unit. The physical stock count on 31st December shows a balance of 400 units. That is okay because 100 units are purchased, they are in hand. Opening inventory, 100 units. Purchase was 1100, so 1200 total. Sales is 800, so 400 units are left in the physical stock. Now FIFO, if you follow the FIFO method, first in, first out and periodic, not following a perpetual system but periodic system, under FIFO method, total stock minus total sales should be the closing stock. So opening stock was 100 units, purchase was 1100 units and sales were 800 units and closing stock is 400 units. Okay, fine. Now purchase of now the 400 units which are left on the reporting date, that is on 31st December, and the FIFO method, this 400 units will be considered to be the last purchase was for 200 units. So the 400 units, out of this 400 units, 200 units will be considered to have from the last purchase and 200 made on 8th December and 200 units from the remaining 200 units for the earlier purchase, that is 2nd of October. The 8th of December purchase was made at the rate of say 3rd of August. From the earlier purchase 500 units on 3rd of August. Now 8th of December purchase was made at 13 per unit and 3rd of August purchase was made at 12 per unit. So on the FIFO method, this 400 units left will be considered 200 units of the last purchase made on 8th December is there, first in, first out principle, and 200 units, remaining 200 units are from the purchase made on 3rd of August. So the cost of these units will be 200 into 13 plus 200 into 12 because purchase on 8 December was made at 13 and purchase on 3rd of August was made at 12. So the under FIFO method it will be 200 units at 12 each and 200 units at 13 each, purchase made on December 8th and August 8th. The total cost of the units will be 2,400 plus 2,600, so 400 units will be cost will be taken at 5,000 using the FIFO method and periodic inventory system. So the cost of goods sold, opening inventory was 800, value of the opening inventory was 800, 100 into 8. We add purchase, total purchase was 12,600, so 13,400. Closing stock is 5,000, so cost of goods sold as per the FIFO method will come to 8,400. The value of closing inventory is 5,000. That is under the periodic inventory system. That is how the calculation will be made. Is that clear to all of you? Any doubts you can raise it now before I move to the perpetual inventory system. Calculation under the perpetual inventory system for the same inventory. You can find that the two methods may give you different values of the closing inventory and also different value of the cost of goods sold. So any question? Okay, sure, I'll explain it again. See, first look at the earlier table. Just try to, how many units are left? That you are clear? Closing inventory of 400 units, are you clear on that? Opening inventory has 100 units. Total purchase is 400 plus 500 plus 200. One on 7th of February, 400 units were purchased. 3rd of August, 500 units were purchased, and 8th of December, 200 units were purchased. So opening inventory 100 units plus purchase during the year 400 plus 500 plus 200. So 1100 units were purchased during the year and opening inventory was 100. So 1200 units total opening plus purchase. How many were sold? 300 units on 3rd of June, 400 units on 2nd of October and 100 units on 5th of November. So total units sold is 300 plus 400 plus 100, so 800 units. So 1200 minus 800 is 400 units. That should be the closing number of units of the inventory. Is that clear? Now what is the value of this inventory? Next question is, what is the value of the inventory? So here we are first considering a scenario where the unit the company doesn't maintain a perpetual system of inventory, but they are maintaining a periodic system of inventory. It means at the end of the year they find that 400 units are left as the closing stock, so they are trying to determine the value of this closing stock following the first in first out method. So what does first in first out method means? This 400 units of inventory, to which purchase you identify the inventory? Because the purchases are made on different dates, different prices. So to determine the cost of this inventory, you need to know these 400 units when they are purchased at what price. So first in first out is basically whichever inventory is purchased first, it will go out or it will be sold out first also. So what remains under the first in first out method, what remains at the end comes from the most recent purchases. What remains at the end, whatever is the closing inventory, that should be considered to have been from the most recent purchases. Now what are the most recent purchases in this case? 8th of December there was a purchase, that is the most recent, but that purchase was for 200 units. So the 400 units which are left, 200 units are from that purchase made on 8th of December at 13 rupees. And the remaining 200 units from the purchase made immediately before that, that is on 3rd of August. So the 400 units should be considered to have come from the most recent purchase, that is on 8th of December, and the remaining 200 units, of the 400 units, 200 units will be considered to have come from the most recent purchase on 8th of December, and the remaining 200 units from the immediately preceding purchase, that is on 3rd of August. That is FIFO. Is that clear, Rituparna? Before I proceed further, I am just asking you, two things I have explained. What is the closing inventory, how much, how many units, that is a number, arithmetic number. Second is, how now you have to identify this closing inventory with the purchase, because the purchase are done. To arrive at the cost, you must know the purchase price. If the purchases are all done at the same price, then there is no problem. You can take the purchase cost. But since purchases have been done at different prices, at different points of time, determine cost, you have to know the closing inventory relates to which of the purchases the closing inventory is related to. So FIFO method tells you to identify the closing inventory with the most recent purchase or the immediately before, like that. Selling price is not important for determining the value of the closing inventory. Selling price is the price at which the inventory has been sold. The selling price has nothing to do with the, as you know, when you talk about the inventory cost, we talked about what are the cost to be included. So selling price is no way connected to the valuation of the inventory. Understand? Only purchase price, cost of purchase, and other things, various other things we talked about, what are the costs included for costing of inventory, that we talked about already. So selling price has nothing to do. So I am talking about this 400 units of inventory left. I have to determine the cost. Now for determining cost, I have to know at what price they are purchased. So basically I have to identify the purchases which are related to this particular inventory. Now following FIFO, if 400 units are left, I will consider 200 units related to the purchase made from 8th of December and remaining 200 units related to the purchase made on 3rd of August. That is FIFO what it does. That is what FIFO is. So 200 units are purchased at 13 rupees on 8th of December and another 200 units, remaining 200 units are purchased on 3rd of August at 12 rupees. So what is the cost? 200 into 13 plus 200 into 12. So 2600 plus 2400. So that is the value of the inventory. Value of the closing inventory. Is that clear now? I am asking Rituparna, is the explanation, does the explanation help you to understand? Okay. So, using FIFO method and periodic inventory system, we find that the closing inventory is 5,000. Opening inventory was 100 units at 8 rupees, so 800 was the opening inventory. Purchase is, total purchase, if you calculate, you can see 12,600. From the earlier table, you can look at the total purchase value. 400 into 10, 500 into 12, plus 200 into 13, that is 12,600. 410 is 4,000. 512 is 6,000, 10,000, and 13 into 200 is 2,600. 12,600 is the total purchase price paid for all 1,100 units. So opening stock is 800, opening inventory 800, purchase is 12,600, so 13,400 less reduced by the closing stock 5,000, we get the cost of goods sold at 8,400. Is that clear? That is determination of the inventory value and cost of goods sold using FIFO and periodic inventory system. Now we look at the same example where FIFO perpetual inventory system is maintained, when the business maintains what is called a perpetual inventory system. I hope this table is readable at your end. Can I read this table? Because here under perpetual inventory system, under the perpetual inventory system, a detailed record of inventory is kept day-wise. Whenever inventory is purchased, whenever it is sold, a detailed record is maintained by the company for each purchase of inventory and sale of inventory. In a periodic inventory system, the detailed record won't be available. Only at the end of the year, the inventory will be counted and its value will be determined using FIFO method. That is what we have done. Last slide. Just a minute. I go back to the last slide before I go to the same example where a perpetual inventory system is maintained by the company. So let me know when you have finished with the last slide. Mandana, when you have finished, let me know. Okay. So, can you see it or? Can you read this? We'll see whether we can zoom into that. Okay, I think now it will be better. So, the company maintains a perpetual inventory system. They maintain what is called a FIFO stock type. So, the same example I am looking at in that scenario where the company maintains a perpetual inventory system by maintaining what is called a FIFO stock card. Manually, it is done like that. In a computer system, it will be done. Computer will keep those records. So, on 1st of January, 100 units were there at 8 rupees per unit. The opening inventory is 800. That is the first line. On 7th of February, 400 units were purchased at a price of 10. The total 4,000. Number of units becomes now Then on 3rd of June, the company sells another 100 units. Which 100 units have been sold? Since it is following the FIFO method, we'll consider the first 100 units which are there at the opening. Those have been sold. First in, first out. So the company sells 100 units for which the purchase price was 800. So that is sold by the company. Total sale is 300 units, remember. Company sold 300 units, out of which 100 units will be considered to have been sold from the opening stock, which was at 8 rupees, cost of which was 8 rupees per unit, and the remaining 200 units were sold from the 400 units were purchased on 7th of February. So we are following the FIFO method here, first in, first out. So 300 units sold, of which 100 units are at 8 rupees, and 200 units at 10 rupees. That is the purchase price of those units. So what remains is basically total sold is So we are left with a balance of 200 units only, each of 10 rupees, and the amount is 2000. That is the value of the stock after the sales is made on 3rd of June. Again on 8th of August, company purchases 500 units at 12 rupees, that is 6000. So what is the balance stock available? 700 units, out of which 200 at 10 rupees and 500 at 12 rupees. So that is the balance stock available, balance inventory available after this purchase. On 2nd of October, the company sells 400 units. Now of these 400 units, 200 units, because we are following the first in first out method, 200 units of 10 rupees have been sold, which are there from the purchase of 7th February, and remaining 200 units from the purchase made on 8th of August. So the total 400 units purchase is sold on 2nd of October will be considered 200 units, remaining 200 units of 7th February purchase and 200 units from the 8th August purchase. So 10 rupee and 12 rupees. So the number of units that remains now is 300 units only from the purchase made in 8th of August at 12 rupees. So the value of the stock now left is 3600. Again on 5th of November, company sells 100 units. So those 100 units actually have come from the 300 units of 12 rupees which are in the stock. So remaining stock is 200 units of 12 rupees, 2400. On 8th of December, company makes another purchase of 200 units at 13 rupees, 2600. So the stock now in hand is basically 200 units at 12 rupees purchased on 8th of August and 200 units of 13 rupees purchased on 8th of December. So the closing stock is 5000. And total purchase is 12,600. So cost of goods sold is 8,400. So this is basically the perpetual method of inventory, perpetual system of inventory, where at any point of time you can know the value of inventory in hand. In periodic inventory system, only at the end of the accounting period a stock taking is done, the inventory is counted and the value of the inventory is determined. But during the year at any point of time, you are able to see the table, isn't it? Any problem in seeing the table on your screen? Because I am explaining from that table, FIFO stock card. So are you having any problem in reading the FIFO stock card, the details in the FIFO stock card? Yes or no? Okay. So this is how FIFO stock card, so the perpetual inventory system is maintained. So detailed recording is, whenever a sale or purchase takes place, a detailed recording is maintained in the stock card, so that at any point of time, if you ask, what is the value of the inventory on 5th of November, immediately you have the answer, the value of the inventory was 2400. Any point of time, if you say want to know what is the value of the inventory on 3rd of June, the value of inventory on 3rd of June was 2000. So FIFO stock card, when a perpetual system of inventory is maintained, then the value of the inventory can be determined at any point of time. But in a periodic inventory system, during the year at any point of time you cannot know the value of the inventory. Only at the end of the year when you take a physical count of the inventory, then you try to determine the value of the inventory. So these are the two systems. We will see again example of these two under average cost method. Same example we will look now at the value of the inventory and cost of goods sold using the average cost method. Both for the periodic inventory system as well as perpetual inventory system. Balance, that is the opening balance, that is the opening balance of inventory as on 1st of January. There is 100 units that was there. It is possible. Purchase price, sell price sometimes can be equal. What is so wrong in that? Purchase price and sales price can be equal. Sometimes even a business can sell below the purchase price, making a loss. Do you think a business always sells at above the purchase price? Sometimes businesses, if they are not able to sell, they will even sell below the purchase price. So I am not going to that why the purchase price and sales price are equal. It can be. We are looking at an example how to determine the cost of inventory. The important thing is to understand how the cost of inventory is determined using FIFO method or average cost method and using different inventory system, perpetual inventory system or periodic inventory system. Now we will go to the same example using the average cost, weighted average cost. Under periodic inventory system, if you use the weighted average cost method, how it works out. So 12,600 was the opening inventory was 800 and purchase was 12,600. So opening inventory plus purchase divided by total units available for sale. That is how we calculate the average cost. So 800 being the opening inventory and 12,600 being the total purchase price paid during the year. So opening inventory plus purchase comes to 800 plus 12,600, that is 13,400. Divided by total units available for sale, 100 units at the opening inventory and 1100 units were purchased during the year. So 1200 units are available for sale. So the average cost of each unit is 13,400 divided by 1200. So 11 rupees 17, 11.17 per unit. So closing inventory being 400 in number, so we will calculate the value of the closing inventory using the average cost at 400 into 11.17, that is 4,468. So using the average cost method, the value of the closing inventory comes to 4,468, whereas the value of the closing inventory earlier using the FIFO method was 5,000. So it will have an effect on the cost of goods sold. How many goods have been sold? Cost of goods sold will be also calculated directly using the average cost per unit. So 800 units have been sold at 11.17, so that is the average cost of each unit. So the cost of goods sold come to 8,932 under this method. So when you are using the average cost method, the value of the closing inventory as well as the as well as the cost of goods sold gets changed. They are different. Okay. Now we'll be saying weighted perpetual. When a perpetual inventory system is maintained, how the weighted average cost will be calculated. This table will show you under the perpetual inventory system weighted average stock card how it is maintained. It will at any point of time you will know under the perpetual system the value of the inventory can be determined at any point of time during the accounting year. That is the advantage of the perpetual inventory system. Okay. So here on 1st of January there are 100 units at 8 rupees was the price, which unit is 800 was the inventory value. On 7th of February 400 units were purchased at 10 rupees. So 4,000 is the purchase price. So in the stock there are 500 units. Total cost is 4,800 till that date, 800 plus 400. So the average price is 9.6 at that point of time. On 3rd of June, 300 units of average cost 9.6 have been sold. So 2,880 is the sales, is the basically cost of those 300 units sold. So the remaining units is 200. Average cost is 9.6. So 1920 is the value of the inventory on 3rd of June. On 8th of August, another 500 units have been purchased at 12 rupees each. 6,000 is total purchase price. The total number of units in hand will be 700 units Cost of the 1100 units will be 1,920 plus 6,000 now. 6,000 is the purchase price paid for the additional 500 units. So 700 units at 7,920. So average cost per unit now works out to 11.31. 7,920 divided by 700. On 2nd of October, 400 units have been sold, costing 11.31 per unit. That is the average purchase price of those units. So the 4,526 is the purchase price of those units which have been sold. So the remaining number of units in the stock is 300 units at 11.31, and the value of the inventory as on 2nd of October is 3,394. 5th of November, another 100 units were sold, and the average cost of those units was 11.31. So the 100 units which are sold, their cost is 11.31. Cost of goods sold is 11.31. So remaining 200 units remains at 11.31. The value is 2,263. On 8th of December, 200 units are again purchased at 13 per unit. So 2,600 is the purchase price paid. So total number of units now is 400. Purchase price is 2,600. The value of the inventory in hand was 2,263. So 4,863 is the total value of those units, 400 units, and the average cost is works out to 12.60 average. So total purchase is 12,600. Cost of goods sold is 8,537. Total purchase minus closing stock, that is cost of goods sold, 6,537, and closing stock is 4,863. So as you can see, under the perpetual inventory system which I had showing in both cases using FIFO and average cost method, the value of the inventory can be from the stock card itself. The value of the inventory on any particular day or any particular point of time can be determined looking at a balance column. The value of the inventory can be determined at any point of time. So the business will be able to say what is the value of the inventory in hand at any point of time, but it is not possible in a periodic. When a periodic inventory system is maintained, this may not be possible. Any question on these two examples? The particular example which we discussed, the valuation of the inventory using FIFO and using average cost method, and where two scenarios where the business maintains a periodic inventory system or a perpetual inventory system. So any questions on these examples which we have just discussed? Yes, Devale Manish. Okay, weighted. Yes, no, you are talking about the perpetual inventory system or the periodic inventory system. In weighted, the calculation shown had different amount of rate than the sum. That means what? I don't understand. Okay, let me go back. Go back to the stock card. Perpetual. So perpetual because just a minute. See, perpetual because when you are maintaining under perpetual, you are every time you are making a sales or a purchase, you are reworking the average cost. See, under the periodic, you are not reworking the average cost every time you are making a sales or purchase. What you are doing is, at the end of the year, you have 400 units of inventory. So you are taking into account the total 12,600 total purchase plus Opening inventory 800 and divided by total units available for sale. So we are making only one calculation to determine the average cost of the inventory. But in perpetual system of inventory, the average cost will keep on changing. The average cost will not remain same throughout. Whenever you make a sale or a purchase, the average cost, particularly when you make a purchase at different prices, the average cost will be keep on changing. So that's why it will be defined the average cost. At the beginning it was 8, then when a purchase of made on 7th February, the average cost goes up to 9.6. On 3rd of June when sale is made, another sale is made. On 8th of August when another purchase is made, the cost goes up to 11.31. And on 8th of December, the average cost goes up to 12.16. So it will keep on changing depending on your change in the purchase price. But on the whole, from the card, when you ultimately look at the column total, your total purchase is 12,600. Your cost of goods sold is same 8,537. Your closing stock is 4,863. That calculation will not differ. There is a difference here, calculation, because here you are working out the average cost at every point of time. And based on that you are calculating your cost of goods sold and closing stock. So that's why in the perpetual inventory system or in the periodic inventory system, when you are using the average cost method, you can find a difference of the closing stock as well as cost of goods sold. Now, as I told in the beginning, IS2 doesn't prescribe which particular system of inventory should be followed by a business. IS2 doesn't prescribe which particular system of inventory records maintenance should be followed by the business. The business can follow a perpetual system of inventory or a periodic system of inventory depending on their system and procedures. But both are allowed, so business can choose their own method of maintaining inventory records. But these methods may make a difference, that's why discussing it, make a difference in the computation of cost of goods sold or closing stock. Because in the perpetual system, you are maintaining a detailed record every time a purchase is made, you are reworking the average cost. You are reworking the average cost, so the average cost will vary. If the purchase price remains same all throughout, then the average cost will not change. But if the purchase price keeps on changing from one purchase to the next, the average cost also will undergo a change. That's why it has gone up from 8 to 12.16. But one can look at the average cost under the periodic inventory system, which was worked out. It was 11.17. It was 11.17 per unit, but here the average cost is changing from 8 to 12.16 under the perpetual inventory system. Now expense recognition for inventory. Whenever inventory is sold, the carrying amount of the inventory should be recognized as an expense and the related revenue is recognized. So when do you treat it as an expense? When the inventory is sold, the carrying amount in the inventory in the books, whatever is the carrying amount of the inventory in the book, that should be recognized as an expense. When your related revenue is recognized. So when you are taking that revenue, sales revenue you are recognizing, then the carrying amount of the inventory which has been sold will be recognized as expense. Not before, not after. Okay. That is basically matching principle. So you have to, whenever the inventory is sold, till the time you are recognizing that particular sales revenue, you do not recognize that expense also. But the moment you are recognizing the sales revenue, the carrying amount of the inventory should be treated as an expense. expense recognition for inventory, what are the other expense recognition for inventory? Whenever there is a write down to the net realizable value, all losses of inventories, whenever we are writing down the inventory to the NRV, whenever NRV is less than the cost, you have to write down to NRV. So all losses of inventories are recognized as an expense in the period in which they occur. So if it is during a particular period, at the end of the period, we are writing down, then for that period, for that accounting period, it will be recognized as an expense. Write-downs can be also the amount of any reversal of write-down of inventory should be reduction to the amount of written off in the period it was reversed. So if any write-down of inventory is reversed, means the inventory which you wrote down, you are reversing it, it will be reduction to the amount written off in the period it was reversed. So this is basically relating to the matching concept, how you recognize inventory, particularly the first point is relating to the matching concept. Okay. So, three things to remember about recognition of inventory, expense recognition for inventory. Number one, the carrying amount of the inventory will be recognized as an expense when the related revenue is recognized, that is comes from matching concept. If there is a write down to NRV, all losses of inventory will be recognized as an expense in the period in which the write down takes place. And if there is a reversal of write down subsequently, it can happen also. Amount of any, because the net realizable value can subsequently go up. Some inventory is there at the end of the accounting period, we find net realizable value is less than the cost. But market may change and net realizable value may improve again. In that case, it can be more than the cost, and there will be a need for reversal of the write down. So reversal of write downs, the amount of any reversal of write down of inventory should be a reduction to the amount written off in the period it was reversed. So if there is any amount written off in the period it was reversed, it will be reduction from the amount written off. So last thing we'll talk about the difference between IFRS and US GAAP. Because we are so far discussing only the IFRS, so we'll note down the points relating to for inventory accounting treatment, what are the difference between IFRS and US GAAP. In the area of costing method, IFRS strictly prohibits last in first out. LIFO is prohibited under IFRS, IS2. Whereas US GAAP, that is ASC 330, they permit LIFO. Second is the costing consistency. Whatever cost formula used must be applied under IFRS must be applied consistently to all the inventories similar in nature or used to the entity. So whatever cost formula, LIFO or FIFO, whichever formula they are using, that must be applied consistently to all inventories similar in nature. You cannot apply to some inventories, you apply FIFO, and some inventories you apply average cost. Being similar nature of inventory, apply average cost, that is not possible. So cost formula must be applied consistently to all the inventory similar in nature or of use to the entity. Under US GAAP, that is not mandatory. GAAP doesn't mention clearly whether it is consistent. It should be consistently used across all inventories similar in nature or use to the entity. Subsequent measurement of inventory, under IFRS it is measured at lower of cost or NRV. Under US GAAP also it is measured at lower of cost or market value. So market value here means instead of NRV they use market value. Market value means current replacement cost but not greater than NRV and not less than NRV, reduced by the normal sales margin, and NRV is estimated selling price less reasonable cost of completion and sales. That is what is NRV as per the US GAAP. And reversal of write-downs, in the area of reversal of write-downs, write-down of inventory to lower of cost or NRV can be subsequently be reversed up to the amount of the original impairment if the reason for impairment no longer exists. But under US GAAP, reversal of write-down is not possible. Once a write-down is made, it cannot be reversed. But under IFRS, reversal of write-down is possible, but it is only up to the amount of original impairment. That means the amount of write-down you did originally, you cannot do more reversal than that. Okay, these are the points of difference between IFRS and US GAAP so far accounting treatment of inventory is concerned. So I will request you to complete your feedback now, because we are coming to the close of the session. And after that we will look at a small problem and finish. Okay, let's look at the last example before we complete the session today. It's on your screen. This company is trying to calculate the value of the year-end inventories for inclusion in their accounts, closing value of inventory. The details of their 3 stock items are given. So what is the value of the closing inventory in the financial statement? So let's see if anybody comes up with a correct answer. So I'm waiting for a correct response from some of you. What will be the closing value of the inventory? These informations are given. Cost is given, realizable value has been given, selling expenses have been given for each item again. I have to value the closing inventory. Actual of the cost or net realizable value. So what will be the value of the closing inventory? So anybody can come up with that number quickly? $265. I get one number 265. Okay. Very high value. So you have taken the added up the realizable value only, that's all what you have done. No. See, what is for the first item? Cost is 100. What is the net realizable value? Realizable value minus selling expense. Correct. Rituparna came up with the right answer. Thank you, Rituparna. Very good. So I am explaining it. She got 215, which is the correct answer. See, for the first item A, realizable value is 120 and selling expense is 25. So net realizable value is 120 minus 25, that is NRV. For A, NRV is 120 minus 25, that is 95. For B, NRV is, net realizable value is 60 minus 5. The realizable value is 60, selling expense is 5, so 55. And for item C, NRV is 85 minus selling cost 15, so 70. Now for item A, carrying cost is 100, cost is 100, net NRV is 95, so we'll take NRV as the lower of the two has to be taken as the value of the inventory. For item B, carrying cost is 50, NRV is 55, so we'll take 50 as the lower of the two, 50 will be taken as the value of that inventory. And for the third item C, carrying cost is 75 and net realizable value is 70, so the lower of the two, 70 will be taken as the value of the inventory. So when you add them up, the total value of the inventory should be 215. 95, which is the NRV of the item A, that is lower than the cost. Then 50, which is cost of the item, because NRV is more than the cost here, you have to take the lower of the two. And for item C, again NRV, which is lower than the NRV of 70, which is lower than the cost of 75. This will be taken as the value of the inventory. So total value of the inventory will be 215. $215 is the total value of the inventory for each of these items. For these three items taken together. Is that clear? So you have to always follow the principle lower of the cost or net realizable value. Here, in this example, the realizable value has been given, but you have to deduct the selling expenses from the realizable value to arrive at the net realizable value. Net realizable value is always realizable value minus expenses in sale. Okay. So using that principle, we arrive at the value of the inventory as 215. Okay. So we are ending the session now today because time is up. So again, see you on Wednesday.